stocks, if you look at categorically the US specific stocks. So the US market has done, if you look at the 1 year period, 3 year period, 5 year period, they have done really well as a broader market and some of the top names that we know of. So will it certainly continue or not? We don't know. So nobody knows all these answers in advance. So in hindsight, we can say that they did well. But if you look at the kind of companies that are growing and becoming larger are the names like Alphabet, Amazon, Facebook, which are new economy companies driven by e-commerce or digital technologies, or a category like digital advertising. For example, ET would know traditional advertising very well and also are part of the digital advertising. But you will see digital advertising companies doing very well. Some of these companies, again, Microsoft is a large company doing very well because they have gone to subscription software, and the company is a large platform of operating systems and everything. So if you look at such kind of opportunities, yes, then there's a pocket of companies that have done phenomenally well. But in the US market, you'll also have industrial companies, manufacturing companies, commodity companies, energy companies. Those may not have done very well. So the constitution of the index also changes over a period of time that drives some momentum in how the broader market performs. But if you are a fund manager or an investor who invest in individual businesses, then you have to be very selective in picking why you choose a particular business to invest in and what kind of quality that business provides at a certain valuation which is comfortable for you to invest in. So broadly, the answer is I don't know if it is going to continue, but if you have chosen a good business which has a long track record, that should do well if the business runway is still available for it to grow. For an individual investor, there are multiple choices how to participate in international investing. So one is, of course, the direct equity option where you open a brokerage account and a foreign bank account and everything, which is the most complex way of doing it. Also tax inefficient in some ways. Then you can go for a 100% international fund, which are many products are available. A fund of fund also available, or a ETF is available. You can do that. And then you can, on your end, do the asset allocation. So if, for example, you have 2 mutual funds to invest in, you choose that 60% of the investment has to happen in Indian markets. So you choose a 100% Indian equity mutual fund. On the other end, you have a 100% foreign fund, which you allocate the remaining option. So you get geographical diversification that way. What we are trying to do in this one scheme is provide our way of managing the funds and give the option to the investor that no matter what money you put in, we will handle the allocation on our end. So if we realize that there is value in foreign stocks to be invested right now, we will invest on your behalf, and that will be up to 35%. And you will get the benefit of taxation like an Indian equity mutual fund because we retain the 65% Indian equity portion. So of course, each person has to consider not just asset allocation, but also taxation point of view from their individual portfolios. I would leave that choice to the individual investor based on what their requirement is. So we provide up to 35% investment, and right now the portfolio is about 30% invested in foreign equity. Okay. And it comes with our way of investing in companies. So we will have our own style of investing. The end investor might have different needs. They might want, say, slightly larger exposure to foreign stocks. So if you want more than 35% investment, they have to choose some other product. So again, with each fund house will come a different set of things. So the category of international fund is quite diverse. Sure. So you will have pure equity oriented schemes. You will have commodity schemes. You will have country specific schemes. It's actually a jungle of different schemes out there. I think we should stick to countries where we're investing for international point of view, where the country should have some sort of good corporate governance. So generally we have seen that US markets, North American markets, and developed Western Europe and developed Asia, these kind of markets are provide a better corporate governance experience. You have reporting standards which are fairly sophisticated. You have information available to the minority shareholders to go through. You have some rights which are exercised and you can actually manage them. But I think in some of the frontier countries that I call, it's very hard to find good corporate governance, rule of law. Think from point of view of a foreign investor investing in India and what kind of situation they will have to face from corporate governance point of view. Many times it's very hard to pick great companies. The same situation you will have. So I think don't go by exotic or shorter term returns. You look at what is the goal of your investing. If you want to diversify based on investable countries where governance structures are good and funds are diversified into good quality businesses. So the way of investing in the mutual fund will be similar, right? I mean, if you go to any platform, you're going to log in, create your own mutual fund folio, and you're going to start investing from day one. It's very convenient now, but the convenience is actually a little bit dangerous because you may choose a product for the wrong reasons. So first of all, you need to have a goal in mind. There has to be some basic financial planning done on your end as to what are you investing towards. So most people think that investing can be an entertaining thing because it's so easy to get in out of schemes. Whatever drives your emotional thing, you will do. It's like stock trading in a way. People are trading mutual fund schemes. So it also sometimes becomes prohibitively expensive because of exit loads that people may not be aware of. So I think you should be aware of what products you're investing in and is this product suitable for your investing goals based on the returns that it can possibly generate. So it's not going to be like every scheme is going to be the top performer scheme every time because you will only see top performing schemes being recommended most of the times. So it's very hard to start for an individual investor who has never invested in a mutual fund. I think the first priority is to have a basic financial goal in mind, then do the disciplined work, like start allocating money slowly and steadily, either from an SIP route or start allocating small lump sum amounts in mutual fund schemes. One thing to look at is the scheme should not have too much overlap in terms of holdings. So if all the schemes are having the same holdings, then actually it defeats the purpose of diversifying across the mutual fund universe. International funds can come a little later when person has some understanding of why they want a diversification, which is apart from the local geography. So this is basically to protect country-specific risk. So right now we are seeing something happening in China, something happens somewhere else, political issues happen, there is demonetization, there is GST implementation, something or the other rocks, local market issues rock the local country stock markets. But that doesn't mean that it will affect globally everywhere. So that is one reason why you should diversify out of the geography that you live in. So to protect yourself from a country-specific risk. So that is, again, these are thought processes. You have to implement them based on your needs. So if you have a need for diversifying geographically, these avenues are available.